Okay, well, thank you very much for having me. It's great to be able to present a paper like this to a crowd like yourselves. So I'm Allison Nicoletti. I'm an assistant professor at the University of Pennsylvania. So I don't have any disclaimers like those that presented before me, so watch out. It's going to get crazy. So just to briefly introduce my co-authors, so Haley Ballou is a PhD student at Ohio State, and Mike Iceland is on the faculty at Minnesota. Okay, so the research question that we have in mind in this paper is, how do regulatory compliance costs associated with the use of bright line asset thresholds and bank regulation affect the demand for acquisitions by banks right around the threshold? So I'm going to get into on the next slide what specific setting we're looking at, what we mean by compliance costs, but I just wanted to quickly talk about the more targeted questions that we're actually testing when we talk about an increase in demand for acquisitions. So the first question is, do banks right around the threshold increase acquisition frequency? So we're trying to look at the quantity that banks right around the threshold are engaging in. And then the second question is, does the deal premium increase for acquisitions made by banks right around the threshold? So looking at more of a price metric. So are banks right around the threshold willing to pay more to complete an acquisition? So the setting that we're using is the $10 billion threshold of Dodd-Frank. So I probably don't need to go into as much detail on the requirements for a crowd like yourselves, but just to briefly hit some high points here. So at 10 billion, banks are subject to several new requirements. So the more significant ones that get talked about are company-run stress testing and oversight by the CFPB. So with both of those two requirements, what we have in mind for costs are costs of hiring employees, software expenditures, things of that nature. So these are going to be more expenses that might be more fixed. The last requirement, so the Durbin Amendment, is more of a reduction in income. So this is a restriction on the interchange fees that banks are able to charge. So with the Durbin Amendment, that's not an expense. It's obviously just reducing income. But when we're talking about this increase in regulatory costs, we're using that very generally. So we're thinking about these three different regulatory requirements, whether they have an increase in expenses or a decrease in revenue, and we're calling that an increase in regulatory costs. And it's important to point out we're not trying to disentangle the specific effects of each of these different requirements. We're just taking these as an aggregate increase in costs. So the mechanism that we have in mind is that there's this large increase in regulatory costs, and that might actually incentivize acquisition activity. And part of the reason for that might be that banks have incentives to maintain different financial statement ratios. So there's been some discussion about ROE, ROA already today. So bank managers are concerned about this huge hit that they're going to be taking by crossing the threshold. Presumably they're going to take some actions to try to offset that. And so what we're arguing in this paper is that an acquisition is a viable strategy because it's going to allow banks to be able to spread those regulatory costs over a larger asset base. And particularly for some of the costs that are more fixed in nature, this is going to be particularly beneficial. So why do we think this is interesting? Well, when we started thinking about these regulatory costs at an asset threshold, it seems as though if you've got this huge increase in costs and a large portion of them are fixed, banks probably don't want to sit right above that threshold because that's where they're getting hit with all of these different costs and their ratios are not going to look very good. So we just put together a simple figure just to see, well, does that seem to be the case? So what I have here graphed are banks between 6 billion and up to 15 billion, and these are $1 billion buckets that I've graphed, so the total assets on the bottom here. And what I'm showing is the striped blue line is before Dodd-Frank, and then the solid red line is after Dodd-Frank. And what this is showing is in each of those buckets, what percentage of banks fall into that. And then the black line that's in the middle, that's our $10 billion threshold. So if you're to the left, you're below the threshold, to the right is above the threshold. So what we see before Dodd-Frank is that generally as banks get larger, there are fewer banks. Not super surprising, and that distribution seems to be relatively smooth, particularly around the 10 billion threshold. Now if we look after Dodd-Frank, that solid red line, we see that it's still smooth, at least to the left of the threshold, but then there seems to be this large drop. So not too many banks are sitting right between 10 and 11 billion. So this seemed consistent with the idea that banks are concerned about these additional costs, and it's particularly costly for them to sit right above the threshold if there's a fixed component. So what might banks do in response to this? Well, acquisition activity, as we've been arguing. And this would also be consistent with some anecdotes. So I pulled, this is just a quote from a Bloomberg article a few years ago that says, the $10 billion sweet spot is proving a boon to regional bank mergers and acquisitions, as small institutions say they need to be bigger to swallow costs to comply with the new financial rules. So this is consistent with the mechanism that we have in mind. And we think all of this is important, just taking a step back, because asset thresholds are frequently used in banking regulation. So we're looking at the $10 billion threshold of Dodd-Frank. There's obviously other thresholds. So to the extent that our results would generalize to those other thresholds, we think this is something that regulators should potentially take into account. Also, there's been some interest recently of the disappearing regional and community bank. So these would be more likely to be the target banks in our setting. But there's been this notion that there's been increased consolidation, these banks have been disappearing, and our results would suggest that regulations might actually be contributing to some of that. Okay, so how are we going to test this? So we are effectively going to be using a difference in differences design. So our first idea is that we've got a treatment group of banks who are right around the threshold, and we're looking at banks between 9 and 12 billion. So you see we're scoping in banks that are just below the threshold, just because there might be banks that are wanting to grow, so they're going to be just below the threshold waiting for that opportunity to effectively leap over. So we want to include those in our treatment group. We cut off at 12 billion just because we've gotten some estimates from banks that say 12 billion is roughly where banks need to grow to offset the costs of the regulatory costs. So that's going to be our treatment group. And we're basically just going to compare what does the acquisition activity look like for banks between 9 and 12 billion before Dodd-Frank to what does it look like for banks between 9 and 12 billion after Dodd-Frank. Now, of course, there's a lot of other stuff going on at this point. So we've got the financial crisis in there, Dodd-Frank itself. So what we're going to do is benchmark this change against banks that are further from the threshold. So trying to difference out the effect of other macro changes and really hone in on the regulatory cost angle. So you can see with this picture here, so our treatment group is 9 to 12, as I've talked about, and we're going to include two different sets of banks as controls. So the $5 to $9 billion banks are going to be useful because they're not subject to the regulations, but they are smaller, and they might even have incentives to stay below the threshold, so they might not necessarily be quite as effective as a control. So to try to counteract that a little bit, we're going to include the second control group, which is banks between 12 and 16. So these banks might be more similar on characteristics like growth and size and things of that nature, but these banks are subject to the requirements of Dodd-Frank. But what we're arguing is that they should be relatively less affected because they're not going to be as hard hit by those fixed costs that the bank sees right above the threshold. Okay, so our first main result is looking at the frequency of an acquisition. So we've got an interaction term here. So this is the change for the treatment banks from the pre to post period, benchmarked against that change for the control banks. We see positive and significant coefficients. So this indicates that following the announcement of Dodd-Frank, banks right around the threshold are engaging in more acquisitions relative to the change for controls. As far as an economic magnitude, this is actually quite large. So if you look at what the unconditional probability of engaging in an acquisition is for the treatment banks, this is an increase of about 60%. So it's a pretty significant increase. The second aspect that we were looking at is the deal premium. And what we find here is that acquisitions completed by treatment banks result in higher deal premiums following the announcement of Dodd-Frank. Again, benchmarks against those control groups. So collectively, what we've shown is that treatment banks are engaging in more acquisitions. They're willing to pay a higher deal premium for the acquisitions. So this suggests that they're increasing their demand for acquisitions in response to the regulatory costs at the 10 billion threshold. As an additional test, what we look at is, well, if it's true that banks are just trying to grow quickly, they're trying to absorb these additional regulatory costs, we'd be expecting them to acquire relatively larger target banks. So we examine that, and unsurprisingly, that's what we find. So following the announcement of Dodd-Frank, the treatment banks are acquiring relatively larger targets relative to the control group. So right now, before this, we focused mainly on, okay, growth opportunities, banks that want to continue growing above the threshold. Well, what if banks are below the threshold and they want to just avoid the regulations, at least in the near term? Well, as a supplemental test, we look at banks that are just below the threshold and whether they have incentives to try to stay small. And the mechanism that we look at is deposit growth. Because as I'm sure all of you are aware, deposits are a key source of financing. They're used to fund assets. So to the extent that banks want to slow down their asset growth, they should slow down their deposit growth as well. So what we predict here then is if banks have incentives to stay small, it's going to reduce the demand for deposits by banks with assets just below the threshold. So we're going to test this in a really similar way to what we did for the acquisitions. So we previously looked at something like a quantity and price of acquisitions. So here we're going to look at the quantity of deposits, or the deposit growth rate, and then we're also going to look at the interest rate that's paid on deposits. And if demand is decreasing, we'd expect a decrease in both of these items. So we have a really similar setup here. Our treatment group is going to be slightly different in that we're looking at a treatment group of banks with assets between 8 and 10 billion. So we are including the 9 to 10 in this test as well, just because it's really hard as a researcher ex ante to determine, well, this $9 billion bank is going to choose to grow, this $9 billion bank is going to choose to stay small. So to try to get around that a little bit, we've just included them in both of our tests. But we're not arguing that banks are doing both of these strategies at once. It's just that there's some banks that are going to stay small and some that will choose to grow. So our results here, so the first two columns are looking at the deposit growth rate. And what we find is that after the announcement of Dodd-Frank, the treatment banks, who are between 8 and 10 billion, decreased their deposit growth relative to that change for the control group. The last two columns, so columns 3 and 4, are showing the interest rate. We also find a decline in the interest rate that they're paying on deposits. So collectively, what this suggests is that banks with assets between 8 and 10 billion might be slowing down their deposit growth and their demand for deposits. And what we're arguing is that's in an effort to try to avoid the regulations, at least in the near term. Okay, so just to quickly wrap up, so our evidence is consistent with an increased demand for acquisitions by banks surrounding the $10 billion threshold. So the implication of this, practically speaking, is that it seems as though the use of thresholds might be contributing to consolidation in the banking industry. So at this point, we haven't done anything to show you any kind of consequences of these acquisitions. All we're saying at this point is just this is potentially something that warrants further consideration, as regulators are evaluating these types of regulations. This also furthers our understanding of the effect of regulations on bank economic decisions and also determinants of acquisition activity. At this point, I don't think we have a great sense in the academic literature of how regulations affect acquisition activity. So this is just a first step in that direction. So thank you very much.